Hi, and welcome to another Finax podcast. This is my colleague, Shimon. Hi. He's a financial analyst in Finax.
And this is my colleague, Tamara, who is our international business expansion manager. And together, today we will be talking in this podcast episode about one of our services, about one of our products. In general, what we do as Finax, to firstly introduce our company a bit, Finax is a Slovak robo-advisory platform. So we automate advisory services. We recommend portfolios suited to financial goals and experience of our customers. And a huge part of what we do is educational and communication content, because we believe that in order to be successful in reaching your financial goals, you should be well educated about what we think are good approaches towards money. So in these podcasts, we often discuss various topics from personal finance, but we also want to use this platform to talk about our products, portfolios, to introduce them to you in human language so that you can listen to it and be well informed whether this is a good product to you. So in today's episode, we will be talking about one such product.
Yes, as you said earlier, one of our products, it's called Smart Deposit, and we wanted to touch base on what it is and why we think it's a very attractive product nowadays. So Shimon, first of all, what is the idea behind the Smart Deposit?
So as the name already suggests, it's more of a deposit product, which means low risk, but it should bear some interest. We saw that due to a spike in inflation in recent years, the central banks, the European Central Bank, was quick to rise interest rates sharply. So the baseline deposit interest rate of the ECB rose from the negative territory up to 4% today when we're recording this podcast. We're recording this in January 2024. So we saw a large spike in interest rates, and we saw that it got reflected in bank products. Mortgages got more expensive, consumer loans got more expensive, credit cards got more expensive. But many banks were sort of slow to respond by also increasing interest rates on the products that the customers benefit from, so on deposit products.
That was a very diplomatic view.
Yeah, I have to be one of the first podcasts. We'll get there. So we saw that on savings accounts in many countries, they essentially remained at zero. And if slowly after many months, interest rates got increased on some time deposit accounts, for example, they had many strings attached. Clients were required to tie up their money for a year or two to get the true advantages, deposit interest rates. They were required to open an extra mutual fund. They were required to use other services of the bank. So many strings attached, little flexibility, and it was relatively difficult for an average European citizen and for an average Slovak citizen, where we launched this product and now want to expand with it. It was relatively difficult from them to actually draw benefits from the increase in interest rates while having to bear costs. So the basic idea was really to introduce a flexible product where people could access the high interest rates in the Eurozone, in the Euro currency, and benefit their savings based on them.
As you mentioned, these kind of conservative products by banks are often tied to something, right? So I think today we want to explain why Smart Deposit is a very good option for the money that you want to park somewhere in a short run. And I think it would be important to explain what does it actually consist of.
Yes. So the Smart Deposit is an investment portfolio, but we will talk about why the risk is as minimum as possible. It is a portfolio consisting of 4 ETFs. Now, 2 of those ETFs replicate the yield of what is called the Euro short-term rate. What is the Euro short-term rate? Euro short-term rate is the interest rate at which banks make overnight loans or overnight deposits at each other. That means those are literally interbank loans for a duration of 1 day, And they charge some interest on it. It is usually quoted on a per year basis, but of course it's divided by the number of days so that just the daily interest rates is charged. And the bank that borrowed these funds for one night because it was short of cash in the very, very short term has to return slightly more. So, and
most of the people basically have no idea that this actually exists, and they don't know what are the rates because it is really interbank thing. So
that is an important thing, right? Most of you have never heard of this because this is not something natural persons such as the two of us, such as the two of us can open and lend to a commercial bank from our own savings. This is really an institution to institution. But what is important to say is that the zero short-term rate is very responsive to central bank rates because banks can also make deposits at the central bank for the interest rates that the central bank charges. So the overnight market sort of has to stay competitive with the interest rates that the central bank is charging.
Yes, this is actually how banks do business. Apart from taking the fees out of their customers, this is the way they basically create more money. Yes,
lending to each other, having the machine rolling.
Yes.
So, but let's not get too technical. That is not that important. The important thing is that the euro short-term rate usually reflects the interest rates that the monetary policy says. So it increased rapidly in the past year, in the past months. And what is also important is that normally it is not possible for natural persons, for us, to invest for this interest rate. But ETFs have been created, and they have actually been on the market for a long time already, that use financial derivatives. And let's not get into details of how they do it here because it's needlessly technical, but they can use financial derivatives to replicate the return on this interest rate, hence achieving an identical, or in the case of one of our ETFs, even slightly higher return interest rate appreciation of invested savings as this euro short-term rate. Some people might be a little afraid when it comes to hearing financial derivatives in terms of risk, but since derivatives in the past during the 2008 crisis already made a lot of fuss, the regulation is very advanced. They have to be secured by very high quality assets. So actually these derivatives, these positions are secured by other assets, and we determine that the risk related to financial derivatives is not material when it comes to these ETFs. So those are the first two positions. ETFs that earn the euro short-term rate, that earn the central bank's interest rates. This is the tool that makes central bank rates, from which usually only banks can benefit, to the wider population, to regular people like us. Then these two ETFs are supplemented by two further ETFs that replicate the yields on short-term bonds. Now, what are bonds? Bonds are debt securities. So those are, as my colleague Rada likes to put it, loans packaged in a security. So when you issue a bond, you issue it and someone else buys it from you. So you technically borrow money from that person buying the bond, and the bond is a promise.
It can be a government or a company. Yeah.
Exactly. So the bond is a promise that you'll repay some interest payments and you'll return a slightly higher amount, that you'll repay the loan with some interest. And this interest is usually called the yield of the bond, if all the promised interest is actually paid off. And short-term bonds in Smart Deposit are very short-term. That is, those are bonds with a maturity of a maximum of 1 year, most of them a couple of months. Most of them a couple of months. Most of them are, even one of the ETFs is below 6 months. The other is up to 1 year. So these are promises to return money within a period of a couple of months, and they have to be made by companies, or one of the ETFs, the smaller position is company debt, and the larger position is just government, short-term government bonds. And one of the requirements for these ETFs is that they have to have what is called an investment grade rating, the governments or essentially the bonds that are being issued. What that means is that they have to have credit ratings by credit rating institutions that assess the likelihood that the promised payment will actually be made, that the institution or the government won't go bankrupt before making the promised payments. And having an investment grade rating means that these are the highest quality companies and the highest quality governments around the world, making it very unlikely that these huge companies, that these huge governments would go bankrupt within the next 6 months or 1 year. That is why short-term bonds are considered to be very, very safe. And even banks, even companies, usually when they want to earn the economy's interest rate, they actually park their money into these bonds because it's very unlikely that a bankruptcy will occur so rapidly with these well-established governments and institutions. Yes, if you have longer-term bonds for a couple of years, even decades, then it's a higher question mark when it comes to risk. But this, again, minimizes the risk. And like most of these obligations, not most, these obligations are always met, we can essentially say. So this is what the ETFs consist of. And by having the short-term yields of bonds and euro short-term rate, it replicates the elevated interest rates that are currently present in the economy.
I wanted to touch base on overnight deposit and the meaning of it. I don't think that many people are actually aware how it works, especially when it comes to yields. So can you explain that?
Of course. Imagine you're a bank and you have cash that you don't need for 1 day. And, these are institutions.
For example, it used to be previously more like that, right? When you were sending money, it took time.
Yeah.
Couple of days to occur on your account, right? So that was the time the bank was holding the money for itself and working with it.
Yeah. But it has to stay there for a couple of days. It can be used for another purpose. So because, these are institutions that try to squeeze every cent out of the available money, they invented the overnight loans principle, the overnight loans mechanism, which really means that they lend money to another institution that maybe for fulfilling some immediate obligations is short of cash and could use it for 1 day. And they charge very, very minor interest rate on it. That means that the company that borrows the money for 1 day has to immediately repay it the next day with a slightly higher amount. So you squeeze a couple of cents. If it's a very huge amount, then even much higher amounts from this. That means these loans are renewed every night. This is something that gets repaid after 24 hours, and then a new overnight deposit pool of loans happens and gets repaid. So they get repaid every day. It gets rolling, and that means that the pool of money grows as more and more money has to be repaid given the initial amount of money that was lent. And that is essentially how the value of the ETF grows, right? What can happen is this euro short-term rate can change over the year, for example. So
it can go up or it can go down,
It
right?
can go up or down. And the euro short-term rate usually adjusts a week after a central bank decision is being made. That means that the yield on these ETFs and on the smart deposit also changes dynamically and responds dynamically to the changes in the monetary policy of the European Central Bank. If it increases, the yield will, after a week, within a week of the decision, increase or decrease. So some people are relatively afraid or consider this a disadvantage, that this is not a guaranteed rate, but it can help. It can also not help, right? If it increases over the year, you'll benefit immediately. If it decreases, yes, in the upcoming months, you will be earning a lower immediate yield. But what is important to say here, I think.
Yes, because this is one of the frequently asked questions. That's why I wanted to touch base on that. So at the moment, it's 3.81, right?
Yeah.
The yield for smart deposit. But exactly, what does it mean? In case, let's say, you're saving for 6 months with smart deposit or investing with smart deposit for 6 months, and then suddenly the interest rate drops for, 25 points. Yeah.
Yes, that's a great question. What I think people and clients are often afraid about is that there's not being a guaranteed rate for 1 year, that this means that when such a drop occurs, they lose the accumulated money that has already been there. So they see a certain percentage of return in their account overview and they are afraid that that can decline. That is not the case. Since overnight loans are made with a high frequency, you cannot undo the ones that were already repaid because those are done deals, closed deals. That we don't return to that. So really, once you earn, and the same goes for short-term bonds, by the way. If already some 3-month bonds have paid out their yields, their interest rates, you cannot undo that deal just because the yield on newly issued bonds is different. So once you accumulate some money in the smart deposit, the return won't decline anymore. It cannot be sort of undone or taken away.
Just the future yield will be smaller in case
yes.
the rate goes down, right?
Yes. Yes, some slight volatility can probably happen, and that is because of the presence of the bonds, because some of you might know that prices of bonds respond very slightly to changes in interest rates. But the main mechanism with which this is controlled in the world of investing is having short bonds, short maturities, because the shorter is the maturity, the less the price responds. And we will be talking about this when it comes to advantages. But the instability of the value of the smart deposit, the, let's say, volatility in its value, fluctuations around some mean are absolutely minimum. It is below 0.5% when it comes to some volatility measures on the level of the European Union. All the ETFs have the safest risk category when it comes to the SRI indicator, which indicates the volatility.
Yes.
All of them have one, and the smart deposit, as we were recently computing, it actually also has one. It had a volatility of around 0.2%, which really is almost no risk, right, to bear. You can also check that yourself because we have transparent accounts.
I was just getting to it, yes.
Sorry. You can go ahead.
As we are trying to be really as transparent as possible, we have plenty of transparent accounts from our clients where you can see obviously different products that they are using, and one of them is smart deposits. So if you would like to check, you can go to our webpage and check one of the smart deposit transparent accounts, and you will see the actual account and how the yield is showing and the actual curve, and you will see that there is really a minimum volatility in question here. So,
but just one concluding thought. So if, for example, yield decreases or increases, the return you have will stay the same, and the amount of accumulated money will stay the same, maybe change slightly by a couple of cents or euro or something, depending on the size of the amount. But the return will mostly stay the same, and it will just start growing at a different pace from that point. But what has been paid out usually cannot be undone.
So naturally, the question why putting your money in smart deposit is a smart choice is a natural one to come, I think.
Yeah, definitely.
Why is it so attractive? Let's tell the audience why we think that this product is really good place to park your money in a short term. So whatever you have on the side, and normally we say short-term investing is the most difficult one because of the possible volatilities and the fact that nobody has a crystal ball. But this is why we believe a smart deposit is a very good product, and any money that you have and you might not need in a couple of months or even 6 months, we know that I often, when we talk about financial reserve, say that, okay, there is one financial reserve that we should have, or emergency fund that we do not touch no matter what, unless I don't know, something really bad happens, and then we go to that fund. The other one is the one that we put on the side knowingly that certain things occur over time. For example, once a year you go and you need to get a new, registration with your car, or insurance for house, for this, for that. So there are these things we do not have as monthly expenses, but we do have them occurring annual. Over the year. So it can be quarterly vacation. So basically it is smart to set aside some money every month in order to create a pool.
Short-term savings.
Short-term savings, yes. Yeah. So now if you know that, for example, in 6 months you want to go for holiday somewhere, right? You can also start putting money on the side. It would be very wise. But why put it on a bank account where the money actually loses value when you can put it somewhere like in smart deposit and earn some money on it?
Exactly. I also, use it for a pool of money. Taxes I have to pay once a year.
I put everything there. What I don't need literally in next 2 months, everything is there.
Yeah. And that is the thing. So let's try to structure the advantages a bit. I think the main feature of the smart deposit that our clients love is its flexibility compared to the competition. That is the main edge. We recommend smart deposit for anything you need within a year. Right, so we have other products for investing over a year. For 1 to 3 years, we have the intelligent wallet. For over 3 years, you can afford already conservative and mixed investments. That's long enough of a horizon to afford some fluctuations in exchange for a greater appreciation of the savings. But within 1 year, so we're really talking about things you might use within 2 months or within 8 months, irregular payments, or if you're going to do a renovation within the next year, but still are waiting for some final bureaucratic things or something like that, then it's often a problem with bank deposit products because it's either savings account with still 0 interest rates or time deposits where you have to tie it for a year or 2 to get the interest rates that truly reflect the economy. And so what is great about smart deposit is that it's fully flexible. That means the yield, the interest rate, it's paid out daily. If you check the transparent accounts that Tamara was talking about, you will see that it sort of almost looks like a linear line of that is growing each day by very small bits and pieces. But if you keep it there for a year, it will earn the average, yield that it had over the year. But it grows incrementally. The yield is being paid out frequently and always. So it's always sort of slowly rising. That means if you need to use the money now suddenly in 3 months, you will still get your portion of the interest rate that you have already earned. Whereas if you're in a time deposit, there are often penalties, right? If you have promised to tie it up for 1 year, you either have to postpone paying that expense until 1 year, or you can withdraw prematurely, but you lose all the interest rate that was already that has already been accumulated in the account up to that point. So in the smart deposit, you can invest, get your interest rate paid out daily, and you can withdraw at any point. We do withdrawals, or we do trading on a stock exchange with a weekly frequency.
At the moment, yes.
Yeah, at the moment. Of course, plans are intensely underway to transition towards a more frequent trading. But you can insert withdrawal orders into your app or into your web account overview each week. And on Tuesday, we do trades. ETFs will be sold off and then sent to your bank account. It takes a couple of days to settle in the stock exchange for us to receive the money, and then maybe a couple of days for it to arrive from our bank to your bank. But you can get to your money essentially within a week or 2 without getting penalties in terms of the paid out interest rate. So this flexibility to use it even for 3 months while still appreciating the money, this ability to use the product dynamically rather than tying it up for 2 years compared to other deposit products, that is something that clients love about the product, and what I love about the product essentially makes it accessible, dynamic.
Yes, you don't need to worry about, the fact that there might be a situation where you have to withdraw money prematurely or part of the money. So you can obviously sell out parts of your account or a whole account depending on what you need.
That's also beautiful, right? Because oftentimes withdrawing a part of the account that you tied up can result in penalties on the entire amount in banks. That sometimes happens. Whereas here, you can withdraw 1/3 and continue appreciating the rest without losing the accrued interest. Then another thing that, of course, is amazing about the product is that it offers a very attractive yield because of how high the short-term interest rates and yields are in the Eurozone currently. due to the monetary policy, due to our attempts to stop inflation. So currently the gross yield of the product is 3.8% annually. It is always slightly below the interest rates of the ECB due to some internal costs of trading, of managing the ETFs and everything. But it's 3.8% currently on an annual amount. This can change. So bear in mind, this is not guaranteed for a year, but if the ECB increases or decreases interest rates, this gross yield can change. And from that, Finax charges a reduced fee compared to its other products, essentially the lowest fee. We charge 0.5% per year, which
including
means,
VAT.
Yeah, including VAT. That's all that is deducted, which means that the interest rate on the product is essentially 3.3% annually, which is much more than most savings accounts, which have the same flexibility of which we are aware of. So it gives you a very high degree of flexibility with a much, much higher appreciation than much competition. So that is the yield, but bear in mind that it can change, for example, if you park money there for a year, but it's a nice way to sort of always benefit from the interest rates that are present in the economy.
And another important thing that you have already mentioned is risk.
Exactly. So let's talk about risk a bit more. This really minimizes the risk. There are people who don't want to risk with this money because they'll need it soon, so they can't afford
volatility,
instability, the possibility that there will be a decline, be it for only a couple of months. But if you need to withdraw the money, you would have to terminate the investment at loss. So you can't afford much instability in the value. And as we already said, due to the safe nature of these investments in terms of credit ratings, so into these ETFs, only highest quality governments, highest quality companies can be admitted. And also because of the very short-term nature of the loans. So it's from one day where changes in interest rates don't affect it in any way other than the future yield that will be earned, to bonds of a couple of months whose price is not very sensitive. This results into low volatility. As I was saying, we were measuring it to be 0.2% according to the standard EU methodology for measuring risk, which is the lowest risk category by far. So it has a risk indicator of 1. But also you can check I encourage you to just check the transparent accounts, just see how straight, how low the volatility in terms of how the account value is growing actually is there on the transparent accounts. So I think we can include them in the description of this video, right?
Yes, we can.
So just go into the description now and you can find it there and check for yourself that the volatility actually is pretty low. So that is great because people who either don't want to risk or can't afford to risk due to needing that money soon, this is really an alternative to other more riskier investments for these people. So really minimum risk, lowest risk category, minimum volatility, while getting a nice yield, a truly nice yield when you think about it for the long term, right?
Yes.
3.3% after fees. That would usually be associated with a significantly higher amount of risk over the last decade. So that's the great thing.
Yes, I think it is worth mentioning here that this product is very popular among our clients. And it is as popular for individual persons as it is basically for the companies. So they also tend to invest their short-term money with smart deposits. So I hope that we kind of painted the picture for you today about smart deposits. If you would like to know more, you can certainly check more product information on our website. If you haven't done so, please subscribe to our YouTube channel and our social media. And we hope to see you, and we hope that you can join us next time as well.
Thank you for joining us today, and be sure to subscribe. We will be looking forward to being with you in the next podcasts. Bye-bye.
Bye.